Okay, his name is Daniel. His name is Daniel. Hey, Daniel.
Nope, it's me again.
Ugh, for crying out loud. All right, what are we talking about?
Mineral rights, investment mania, and helping someone recover from a scam.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, well, that's a pretty diverse cast of topics, so where should we start?
I want to start with mineral rights because I have a couple questions about that.
Okay, shoot.
Well, we've talked to a few people about them over the last year. Someone recently was saying that they had sold their mineral rights, one of our clients, and what to do with the money, etc. But that reminded me that I don't know a lot about mineral rights in general. I guess I don't understand, first of all, the frequency of it. It doesn't seem that common to me that you buy land and then later find out that there might be something valuable on it that you get paid for. They offer to buy it from you. How frequent is this?
Well, I think the first thing is to understand kind of where mineral rights come from or where they kick in. The starting point might be something like the Manifest Destiny. So when we spread across the United States and people settled areas and created towns, so on and so forth, in the general sense of property rights as they sort of have existed essentially forever, when you purchase property, you effectively own, the land, the dirt, the surface that you're on, and then you, unless there's sort of a difference in what you've actually purchased or a special circumstance, you own what's attached to it, or at least have rights to what's attached to it. So, for example, if you bought a patch of dirt somewhere and it turns out that there's oil or copper or gold or something underneath it, technically that's legally yours. The same thing can apply to things like water rights. If your property backs up to a lake or a creek or a river, generally speaking, particularly if you're the very first owner of that property, you're going to have rights to that resource. So that's sort of the basic principle. Now, some people don't have rights because those rights have previously been sold by previous owners of a property, or in certain cases, when a property was developed or when land rights and permits were issued by a municipality, those rights may not actually accrete to that property. So, for example, a city might build a house or have a housing development built around a lake or a pond or something in town, and may, as part of the development, have decided that there's no rights to that lake or that pond just because your property is next to it. So it's all sort of case by case. But generally speaking, unless there's a special circumstance like that, you own the value of the land, and that is going to include access to the mineral, the oil, the gas, the water, or anything else that might be part of that land.
Is there a way to look it up if you're not sure if your property has that?
That's going to be part of your actual ownership. And this is where you sometimes get into sort of title problems. So the entire industry of title insurance essentially exists to mitigate the risk that you've purchased a property and somebody else had a claim to it or some other encumbrance upon it. So to make up a hypothetical here, let's say you buy some land in the middle of nowhere, Nebraska, and somebody comes to you later on and says, "Hey, we think there's oil under your property. Do you want to receive payments from us in return for letting us tap into that oil?" And you say yes, but a prior owner of the property may have sold those rights. Now, theoretically, that would be conveyed in all of the property ownership documentation that you signed when you purchased your property, but it's not uncommon for the record keeping to not be done very well or for documentation to have gotten lost. So it should be part of your property ownership documentation, but that doesn't necessarily mean that that documentation is accurate.
No. But what if someone doesn't approach you offering to buy it or mine on your land or something? Is there a way that you can use the rights if they don't come to you first?
I mean, theoretically, depending on what the resource is, you could certainly make personal use of it. Now, that gets a lot into like permitting and resources, right? Like, if I realized that there was a copper deposit under my house in the middle of a neighborhood, I think the city and my neighbors would probably frown upon it if I just like opened a mine shaft and started like pulling a bunch of dirt out. So, there's definitely limitations based on the county, the city, the municipalities you might be part of. But frankly, most private citizens don't have the money or research, or for that matter, just like basic resources and know-how about how to extract those resources. I think out here in Longmont and Boulder County and Colorado as a whole, the most common example of this we're going to run into is oil and gas rights. And in that particular case, the challenge there is that often whatever that resource is doesn't just singularly live under your property. It's not like there's just like a little pond of oil or something that happens to follow the boundaries of your property. Chances are your property sits on top of a large pool or set of shale or something like that, that functionally then you own a fraction of. And so, if there's a interest in tapping that resource, both you and your neighbors and the other property owners above that particular resource all have to sort of end up in a kind of an investment pool to have a company come in, tap that resource, and then pay you all royalties for the use of that mineral right on your property.
What if you and all your neighbors don't agree on it? Some of you want to and some don't.
I think this is where we get into the plot of the movie There Will Be Blood. And for anybody who never saw that, I don't know that it's worth watching, but Daniel Day-Lewis is a good actor. But the analogy that happens in that movie, and spoilers for anybody who wants to go see it, is at the very end of the film, a preacher who's been sort of harassing Daniel Day-Lewis's character, who's sort of a oil-based robber baron type, comes in and, many decades after the plot or the conflict is sort of over, says, well, we've come on hard times, so now we'll sell you our oil rights, to which Daniel Day-Lewis uses the analogy that if he drinks his milkshake, then his straw will simply go over into your milkshake and drink your milkshake. It's a whole weird scene, but that's sort of what's going to happen here, right? Once somebody starts tapping into that, your only cause of action would be to try to sue and prevent it and say, hey, you're stealing my resource. You can't do that. But once there's enough critical mass in the area, it's sort of a, hey, get on board or miss out sort of thing. And this is a whole area of law. There are entire law practices dedicated to mineral rights and oil and gas and so on. But functionally, in a real practical sense, if somebody is draining the proverbial lake under your house of that resource, and you want to stop them, unless you can actually get a court to put an injunction in place, they're going to keep draining it the whole time. And just because you didn't agree to it doesn't mean that it's not eventually going to get depleted.
So you don't really have that much say in it as you'd like to think you do if all your neighbors want to do it.
That's kind of a big piece of it. And locally here, particularly in northern Colorado, we've had a number of laws and regulations passed over the years sort of trying to put a damper on that. I think even the city of Longmont at one point tried to forbid fracking from within its sort of city boundaries, municipal influence. And the problem with that is that represents a taking, right? That mineral resource, even if you have, let's say, environmental concerns, ecological concerns, right? That is a resource. And when the government or when other private citizens tell you you can't use a resource that you own on your property, even as it may be attached to other properties, that represents a taking. And so in that sense, often laws or regulations designed to curb that end up falling apart or not making it very long, simply because at the end of the day, there's a lot of money in the use of these resources. These resources are needed and necessary, at least in the world we live in today. And so consequently, at the end of the day, generally speaking, oil and gas companies or mineral extraction companies are going to get their way unless you have a huge block that has total control over that resource and wants to deny them access to it. Because then you can't force you, but when your resource like a shale belt or something like that is shared with your neighbors, it's going to be very hard to get a unanimous outcome there. And ultimately, then you're going to be subject to the whims of even a minority that probably may want to extract the value.
I guess that makes sense.
Well, and it's just what happens in practicality, right? I mean, imagine, if you had any other resource. I mean, let's say you have just a river running through your property. You might want the river to remain full and beautiful and bountiful. And so you might decline to extract any water from the river, but that says nothing about what your neighbors may or may not want to do with that water.
Yeah, well, I better hope you agree with your neighbors then. All right, well, I have some questions about investment mania.
Okay, well, that's a big plot twist. So be a little bit more specific, because investment mania has a multi-century history across a whole number of interesting assets.
Well, specifically around the office this week, we've been talking about that Roaring Kitty guy and the GameStop and all that stuff. And I don't quite understand why he's doing what he's doing. So.
Okay. Well, I think let's bifurcate the Roaring Kitty GameStop story from investment mania as a whole. So let's just talk about mania first in general. The first investment mania that's sort of known in history is what was called tulip bulb mania. And this goes back to, I believe, the 16th century or the 17th century. And essentially, literally tulip bulbs, like what you use to make pretty flowers in your yard became sort of this coveted asset. People were buying and selling them and trading them, and they just became in such high demand that their value went up and up and up, where people were spending something like the modern day equivalent of like 10, 15, $20,000 for a tulip bulb. And at the end of the day, it's just a flower, right? It's not special. It didn't have like great medicinal properties or anything. And eventually, even though the demand for them grew and grew and grew, eventually that demand evaporated, and suddenly the value of those bulbs collapsed. So mania tends to take effect in asset classes where a fear of missing out kicks in, where people say, well, gee, that thing keeps going up and up and up, and I don't want to be a person who doesn't get on board with making all the money. It seems like everybody's making money from that. So then they buy into it, and that behavior repeats itself across hundreds, thousands, or millions of people. And so that desire to not miss out on it pumps the value of the asset beyond what its actual potential value is. So I can give it one securities-based example and one other example today. One might be NVIDIA, and it's not to say anything about the value of NVIDIA, the quality of the company, anything like that, but NVIDIA this year has already more than doubled in value, simply, I think, at this point, because there's sort of a fear of missing out by a lot of investors. They're seeing this company go from sort of a small tech computer chip company to now essentially the most valuable company in the world. And that has largely happened not only on the back of NVIDIA's business activities and returns and profits and so on, but also simply because right now there's such a focus on it that sort of everybody wants to get in on it. And so there's a realistic question about that type of event for any company, not just NVIDIA, that at some point it could be so overvalued that the bubble might pop and suddenly a lot of people could get left out. A example that I've talked about in many other mediums before would also be something like cryptocurrency or Bitcoin, which is intrinsically worthless, but there's been such a mania around crypto assets over the past decade that there have been boom and bust cycles where everybody's wanted to get on the crypto train or the Ethereum train or the Bitcoin train or the NFT train, and have bought up these worthless assets for crazier and crazier amounts of money simply out of fear of missing out, and then suffered from sort of the bubble pops that have occurred over the years.
And so that's the exact same thing that happened with all the GameStop stuff the first time, right?
Kind of. There's, I think, a slightly more interesting plot around that. So for anybody who doesn't remember, a couple of years ago, essentially a bunch of investors on Reddit through a subreddit called Wall Street Bets listened to the kind of analysis and arguments of a user named Roaring Kitty, who has since come out as a man named Keith Gill in Massachusetts, who essentially argued that GameStop was actually deeply undervalued and that the stock was so undervalued that it was a great investment. And he personally sank a huge amount of money into buying the stock. But as part of that, he made a compelling argument for some investors to get involved there. But then the sort of icing on the cake was that a number of hedge funds had decided to short the stock, meaning that they were selling the stock without owning it, expecting the company to go under so they could then repurchase the stock and return it to whoever they borrowed it from for nothing, right? Or for way less than they'd sold it for originally. And so the argument here was, hey, these hedge fund people are trying to sink this great game company that all of us went to when we were kids, and we should all band together and buy the stock in order to stick it to them and keep the company alive. And that happened. A ton of people bought into GameStop stock such that the company and its stock price exploded and essentially crashed a lot of these hedge funds, or ruined a lot of these hedge funds, simply because the market, for no reason other than just sort of this fantastical idea of piling into the stock, decided to buy in. Now, the more recent event has come out that after there were investigations and various sort of things that happened years ago, the same person, Keith Gill, Roaring Kitty, went and recently purchased an enormous amount of call options. Call options are essentially a bet that a stock will go up, and then that bet comes to light or functions in that you've paid for a contract that somebody else has sold you. And what that contract compels is that the person who sold the contract, if the stock exceeds a certain price, has to sell it to you at that price. So if the stock was worth, let's say, 30 today, and you bought a call that says that you'll buy the stock at 40 if it gets above 40, then if the stock goes to, let's say, 90, 100, 150, 200, and these are all just made up numbers, you still only have to pay 40 for it. So then your potential return is enormous. Well, in this particular case, Keith Gill went and got a ton of call options on it. I think several $100 million worth of call options. And then his reputation from the previous mania around GameStop is so significant that when he made just a social media post essentially saying or suggesting that he was going to get back into GameStop stock, the stock exploded. Once again, a mania has occurred and driven the price up enormously. And so he's now made, essentially at this point, several $100 million off of the value of GameStop stock out of no fundamental activity of the company itself, but simply a public desire to own as much of it as possible.
Are you allowed to do that? That kind of sounds like market manipulation of some sort, but I can't quite put my finger on what it would be.
So that's sort of the most interesting thing here is I think at face value, we all see something like that happening and say to ourselves that that's wrong, that shouldn't be allowed. The trick here is that technically Keith Gill or somebody in a situation like him is a private citizen. He didn't have insider knowledge. He didn't have undue influence on the markets, and he's not lying to anybody. He's not deceiving anybody. So it's not like he bought a bunch of the stock and then tried to get a bunch of other people to invest in it just so he could then dump it. It's not a pump and dump scam. There's no hiding the ball here. He's just sort of openly and obviously been this massive GameStop stock company fan for many years and very openly has just sort of advocated for it and has coincidentally done quite well doing that. I do think there's a possibility that we could see some sort of law or regulation passed in light of these types of events to prevent it from happening in the future, because in total fairness, there are other people on the side of these bets as far as the options go, or as far as like the short sellers back in the previous instance. But as far as I'm aware, and from every securities attorney I've talked to around this subject over the last couple of weeks, their impression is that he hasn't done anything illegal. We just sort of frown at it because it feels wrong, but it's not actually illegal.
Do you think he'll do it again? Because he's kind of doing it a second time now, just in a different way. How many times can you do this before it doesn't work?
I think that actually more depends on the public. I don't know that he's going to buy it or sell it or hold on to more of it. That's a complete speculation. I think the question about how much it can work really just depends on the public's appetite for it. At the end of the day, he's a guy sharing his thoughts or opinions on this particular company and this particular stock, and the public seems eager to follow suit with him, even if it doesn't make any sense. Now, can he do it 2 times, 3 times, 5 times, 10 times? I have no idea. But from a certain standpoint, I don't think that there's going to be a constant compounding return on that activity. I would expect at some point the public would get tired of that game or those shenanigans, if only because if he keeps doing it enough, he's just going to become a bigger and bigger and bigger shareholder. And it's not that the public would respond to him there. It's just that if we follow that to its logical conclusion, there could come a point at which the market for GameStop stock becomes illiquid because there's not enough trading volume. There's too much money being held by too few people. And so any movement to try to get out of it in the future, if you've become, let's say, the 60% shareholder of this private company, and then you try to sell half of your holdings, well, you're trying to sell 1/3 of the stock for this entire company, theoretically all at once or over a short period of time, and that activity alone would easily cause a stock to tank. So there is sort of a ceiling on how much potential return there could be from an activity like this, but at the end of the day, it's going to be largely driven by mania. Does the public get on board or not?
That fascinates me. I like talking about that. But now I'm pivoting again.
All right.
I have another question for you. This one more pertaining to scams in general. A little bit of a segue here. But, I hear a lot of people that have been scammed or misled in different ways. And I'm not really sure, once it's already happened, how do you address that? We're always trying to get ahead of it and make sure it doesn't happen. But once it does, what are you supposed to do? Like if someone was tricked into buying a worthless asset that, like a worthless foreign currency or something.
I have a good anecdote about this. A number of years ago, a client fell prey to what's called a pig butchering scam. And the way that happens in a short description is you meet somebody online or virtually, and they share sort of all this exciting stuff they're doing around investing. And they're not trying to sell you on anything. What they do is they trick you into depositing your money at a not real institution. So like there'll be an app or a website and like it looks like a brokerage. It looks like a Fidelity or a Charles Schwab or something, but you deposit your money in it and then on that platform they might show you fake rates of return on your investments such that you think you should invest more money, but on the back end your money is just being stolen. And there was a person several years ago I know who got pulled into one of these and ended up borrowing essentially an amount equivalent to about half of their annual income from the bank as a personal loan, thinking that they would just make so much money and that would cover it. And it was just gone and there was no recourse for them. I share that as just a specific example of what a scam could look like. And you mentioned things like buying worthless currencies, or another common one is people buying collectibles, thinking that there's going to be a good return on the collectible, but sometimes the marketplace for collectibles doesn't really go anywhere. It just depends, like with manias, is there enough demand for that thing or not? In the case of how to deal with scams, I think what we have to recognize is, number one, there's the question of whether the person who's been scammed recognizes they've been scammed. Because until they recognize they've been scammed, you can't move on, right? At the end of the day, you have to either convince them or show them or demonstrate or prove to them sufficient that they recognize and believe they've been scammed. The second thing that comes along with that then is whether they logically and like rationally recognize it and know it. Will they accept it in practice? Because to admit you've been scammed is on a certain level to acknowledge that you feel stupid or you've done a stupid thing. And it's not your fault, right? The victim is not at fault here, but there is a point at which you have to recognize, okay, like I did something that was not in my own interest. I've given my money over to bad actors, and consequently, I've lost money. I've really lost money. I've been stolen from, and that can come with a lot of complex emotions. Whether it's guilt, right? Did I lose money I couldn't afford to lose, or shame? How do I tell my spouse, my kids, my partners, whatever, about how I've lost this money and what that means for us? There's a lot of challenges there, and how you deal with that as an individual and come to reconcile or come to terms with the fact that you or somebody has been scammed.
So, I mean, in most cases, you're not getting the money back. It's just a matter of talking them through the acceptance of it and making sure they don't do it again in the future.
And in that regard, I do think it matters what the scam is. So, like I described pig butchering, where your money might as well have been thrown in a fireplace or put through a paper shredder. Like you're never getting that money back. In cases where you've invested in something that's just not worth owning, so something like purchasing a worthless foreign currency or purchasing a collectible, sometimes the decision then is just to cut the loss. And that is better than just having lost all of your money. But that does sometimes mean that you have to accept that you now have to recognize, a 30, 40, 50, 60, 70% loss on your money. So you put in $100,000 and you're going to walk away with your sort of battered pride and 30 grand. But at least you have the 30 grand. That's really just the nasty, awful part of it, is at the end of the day, there's a huge, huge amount of people who are not necessarily being scammed so much as just being misled. There's you've watched Margin Call recently, right? The line from Jeremy Irons where he says we are selling to willing buyers at the fair market price. Sometimes it feels like a scam when you realize kind of what you've bought, but the reality is it wasn't a scam. You just made a really poor choice, and the same emotions might come into play there. But I think fundamentally, whether you've been scammed, whether you're trying to help a friend, a family member who's been scammed, the biggest thing to do is, I don't want to say get over it, but it is to accept it. Right? I've made a mistake. I have to own the consequences of that mistake and the harm and the impacts that causes. And now I need to move on and do whatever I can to mitigate the damage of that mistake, because the mistake has been made. And if you can get to that as quickly as possible, that's the best place to get to, because when the harm is done, the harm is done.
Would you say those type of scams are more common, the ones you're talking about, where they're trying to get you invest and buy, versus just like wire fraud or Venmo or whatever, where it's a one-time transfer and it's just gone?
By volume, they're both pretty enormous businesses. I think there's a different way to think about them. In the cases where it's like a collectible or a bad asset, many times even the people selling it to you would never agree that it's a bad asset. They own a mining operation, or they have a huge amount of this currency, or they've got the world's largest sports card memorabilia collection, whatever it is. And so they look at it as a product or as an asset that they're selling to you. They wouldn't agree that it's a scam or that it's been a bad investment or a bad idea. Now, you could logically say, well, then if you think it's so great, why are you selling it? That's sort of a byproduct conversation. But simply by extension, at the end of the day, you're providing this poorly constructed or illiquid asset holder with liquidity. You're giving them the opportunity to convert these assets to cash. You get the asset, they get the cash. And by the power of hindsight, we realize we would rather have had the cash the whole time instead of giving it away. In the case of the opportunities to just give your money away, right, to put it into a fake account or transfer money to the fake place, that's a billion-dollar industry at this point. Quite famously, there are a number of entire facilities, particularly in sort of South and Central Asia, dedicated to this, where you have people as full-time jobs, whether willingly or in some cases as essentially slave labor, spending all day, every day trying to scam people out of their money. And it's a business to them. Whereas for us, it's individual victimization, but it's effectively just a full-time business operation held overseas, trying to take advantage of people. And the volume of that has been in the hundreds of millions and billions of dollars for years now. So it's not a question of which is bigger or better or worse. It's just a matter that at the end of the day, there are some seriously worthless illiquid assets out there that sometimes somebody's going to try to convince you to be their exit liquidity for. And in other cases, there are just plenty of bad actors out there trying to take your money, pure and simple.
What a cheerful note to end the podcast on.
Well, then let's find ourselves a more cheerful note. So you have continued to study for your securities licenses stuff over the past couple of weeks. And since you've had now 2 weeks to ponder it, what is the biggest or most useful thing you've learned in the last couple of weeks?
Oh, let's see. I've been doing a lot of technical learning that I don't think is very intriguing for a podcast, but I've been doing a lot of, call options. Actually, you touched on that earlier, and the details of all that, which I think I mentioned in a previous podcast. I don't get the hype for why people are so interested in it. It's endlessly complicating to me. I mean, you can make a lot doing it, but even as I get deeper into it, I can't say that I would ever bother.
Well, and in that particular regard, I think at the end of the day, where there's money to be made, there will be somebody who's interested in making that money. Whether it's a good or bad idea for you individually has a lot to do with your own skill and capacity and tolerance for risk. But there's a marketplace for it because there's a demand for it.
Yeah, that's true. There's plenty of it out there.
True enough. Well, thanks for listening, folks, and we'll see you next week. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.